now we reach our final principle. It's called societies faces a short-run trade-off between inflation and unemployment. It's also a very long topic of macroeconomics, but I will try to make it short so you can understand. There's one term that I have to define first. It's called business cycle, and that's actually the fluctuation in economic activity such as employment and production. So during a business cycle, sometimes production goes high and other times production goes down due to different reasons. Okay, so what this concept actually means. Probably it's good to give this example of the financial crisis of 2008 and 2009, which happened first in the United States. And after that, the government of Barack Obama, they wanted to increase inflation in a way that they wanted to increase the amount of money in the market, and they also wanted to increase government spending. So that would increase the amount of employment again. So if you're if you're trying to put more money into the economy and you're printing too much money in the economy, that will actually, as we discussed in the last principle, it will generate inflation. So inflation will also bring up the unemployment rate down, because the economy is operating in a nice in a way that a lot of economic activities are taking place, and that results in unemployment rate to decrease. I will try to put this in a better way so you can understand. I will rephrase myself in a way that when you want to recover from an economic crisis, for example, what you will do, you will try to increase inflation. That will also increase employment for a while. But inflation is not good for the economy. It's actually an enemy of economy, but employment is good for the economy. So government, they also have to face this trade-off. Do they want more inflation or do they want more employment? So this is the decision of policymakers, that they try to balance how much inflation they want to have and how much unemployment they want to have. So that was our last principle. I will quickly review the last three principles, which was about how the economy as a whole works. Our eighth principle was a country's standard of living depends on its ability to produce goods and services. Principle 9 was about the prices rise when the government prints too much money. And then principle 10 was society faces a short-run trade-off between inflation and unemployment. So that was most of the topics covered in this first chapter of this book, and I hope this has given you a flavor of this economic, as well as the coming chapters that will follow. So these principles are actually not universal, but the author of this book has brought this concept right at the beginning, so it's easy for us to have an idea about the economy and how it operates. But actually throughout the book, these principles will come up again and again, and it will remind us that, okay, based on this principle, it applies to this concept in the same way. So this will help us understand other economic concepts going forward. And we can we can see that these principles are actually make sense, so they are practical, and they will help us understand more complex issues going forward. That was all for this first chapter. I hope you've got an idea about the content of this book and about the subject in general, and looking forward for the next chapter. And the next chapter is a bit interesting. The title is Thinking Like an Economist. Have a nice time and see you in the next lecture.